All right, everybody, welcome to the fourth quarter scouting report for 2025. My name is Adam Koós. I'm the President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio. I'm going to jump right into this because we have a lot to go over here today. If you need to get a hold of us, of course, you can get a hold of us on our website at libertaswealth.com. If you'd like a second opinion on your financial plan, your retirement plan, your investment portfolio, and of course, if you don't have a financial plan or retirement plan, you probably should. So please reach out to us if you're interested in talking about that, just to set up an intro call. That would be the first step. So all you're doing is reaching out to us either on our website, you can email us, and we would get a 30-minute intro call set up on the calendar to get to know you a little bit better, understand your needs, what you're looking to accomplish, whether you're working toward retirement or already retired and wanting to stay that way. But you can also find all of our socials as well up here on your screen in case you want to connect that way. All right, moving on. I always have quotes, big quote collector. And today I have two quotes, actually three. No, I'm sorry, I have three quotes. The first one is, bull markets climb a wall of worry. This is Joe Granville. And obviously that's what the market's been doing. People are very worried. There's concerns about the economy and people are freaking out. And as the market just continues to go up, regardless of going through the worst 2 months of the year for the market on average during a post-election year, August and September ended up being positive months when usually they're the worst months of the year. We're in the midst of a government shutdown and the market's doing fine. So climbing the wall of worry, that's what it's doing. Bob Farrell said, if everyone's waiting for a pullback to buy, either the market doesn't have a pullback, or if it does, you shouldn't buy into it. So again, more climbing that wall of worry. And then Richard Russell said, big bull markets always find a way to keep you frightened and out. Big bull markets are devils with no conscience. To get in, you have to close your eyes and just do it. It's not easy, but in this business, nothing is easy except losing money. So how about that? All right, I'm going to talk about the elephant in the room right off the bat here. We're going to talk about the government shutdown. This is the last 6 times the government shut down, not including the one we're living in right now. If you go back to 2018, and the market was, I should say not the market, the government was closed for 35 days, and it was up 10% over that time period. We had, the seasonally positive months, of course, at our back, the wind at our back. We had the Santa Claus rally. We had a good January. So 10%. In 2018, the government was shut down for 3 days, and the market was up 1%. In 2013, the government shut down for 17 days, and the market was up 3%. In 1995, it was only 22 days. Sorry, it was shut down for 22 days, and the market really didn't go anywhere. It was pretty much flat. In 1995, again, earlier that year, the government shut down for 6 days, and the market was up 1%. And then last but not least, back in 1990, the government shut down for 4 days, and the market was down 2%. But of these 6 times, one was flat, one was down 2%, and the others were up. So government shutdowns are temporary. They happen. Maybe they're scary. Obviously, people don't get paid. If you're in the public sector, that becomes a problem temporarily. But that's the infinitive word here, is that's temporary. And the markets usually just don't care. And at least so far, the markets aren't caring all that much this time. So when you go back to all the shutdowns, and I believe this is the 23rd shutdown, I think, since 1950. I could be wrong about that, but this is all the shutdowns going back to 1976, and you can see here that this obviously is just a couple days old, but December 18, 35 days. So this has happened before. That's my point, is to say that this isn't something new. I think people forget about it because it kind of, we go through the news cycle, it happens, it's over with, and then we forget it ever happened. But this has happened many times. So it's not like we haven't seen this before. And then I was talking about the month of September. So again, September is the worst month for the stock market each year on average. And August is usually the second worst month for the market, especially in a post-election year. And what we've seen this year is we saw a positive August and a positive September, and it was the second best September performance in 27 years. So I think that speaks good news for the market, regardless of a lot of the bad news you're seeing out there. What we do at our office is we're always looking for evidence, positive or negative. And we're not trying to be positive or be pessimistic. We're just looking at things objectively. What are the markets telling us? Is there something to really be concerned about or not? So speaking of the market, here's the S&P 500 going back to March of 2024. And as I look at the screen here, we have the market trending up off the tariff crash low back in spring. and it's trending up, rising above a rising 50-day moving average, so a 50-day trend line here. So it's trading above that. A couple little pullbacks here and there, but nothing crazy. And it's trading above a rising 200-day moving average, so 200-day trend line. There was some momentum divergences here that we were seeing. So these declining tops would be an RSI divergence, a negative divergence, which would hint that maybe the market might struggle at some point in the future. Now, I know that there's some people who might try to draw a line between this top here back in summer and then this top we just saw a few weeks ago. And you could do that, but when I look at this, the RSI crossed back above 70. So unless you're trying to draw really, really super ultra short-term divergences, which I don't, I'm more of an intermediate-term investor myself. That's how we manage our clients' portfolios, is intermediate term. That's our time frame. So I'm not really looking at this short-term stuff right now in terms of how we're managing portfolios or making changes to our portfolio or potential changes. So this negative divergence we were seeing was negated by that most recent uptick, and everything looked good here. So uptrend, no more divergences in the long term or intermediate term for that matter, and I think everything looks okay. When you look at some of the internals in the market, when we look at some relative comparison charts, discretionaries are luxury goods, things we want. Consumer staples are things we need, things like razors and groceries. So whenever you see this chart going up, that means that luxury goods are doing better than the things we need. And when the market's doing well, in other words, when the evidence says we can take more risk, it's saying that because we can buy more luxury goods, things are okay. If we saw this chart upside down, like back here in late 2022 when it was trending down, what that's telling us is that people are more focused on the things they need and they're not spending as much money on the things they want, the luxury goods. So what we're seeing right now is not only a positive trending relationship here, so again, discretionaries outperforming staples, but we're also seeing a breakout above the, call it December, January highs. So this is all good. It's good. It's more good evidence. If I look at another comparison that's very similar, this is the difference between technology, so tech stocks, and utilities, which are considered widely to be a defensive sector. So again, if this is trending up, then that means technology is outperforming utilities, and if it's trending down, that means utilities are trending are outperforming technology. Obviously, when technology is outperforming utilities, that's considered risk on. It's considered risky business. People are taking not that the market's risky, but it means that people are taking risk, and the risk on is the way to be. So the evidence here I'm looking at is another piece of evidence in favor of the bulls, not the bears. And when you look at a bunch of sectors across the board here, so this is all the S&P spider sectors. You can see the stuff down here at the bottom. This is the more defensive stuff: staples, energy, real estate, healthcare, which is finally starting to pick up here recently. But the stuff that's doing well: communications, technology, luxury goods, discretionaries, financials. As one of my friends often says, you can't have a market crash without financials going down, and we see financials going up, and the S&P as a whole going up. So the market still looks really, really good when you slice it and dice it in many, many different ways. What are the concerns out there? My good friend Andrew Thrasher, he does some great work on the volatility index on the VIX, and one of the things he's been talking about is not only has the VIX become compressed. So this is, and by the way, I should back up. The VIX is the volatility gauge. So basically, when it's trending down or when it's low, it means that the market is not very volatile. There's not a lot of big swings up and down, or I should say up or down. So when the VIX is high, that means that the volatility is very high, which means that we're seeing big wild swings up and down. So not only has the VIX become compressed here recently, but it's also been in such a condition for more than a month now. And what we're looking at is a chart of the VIX since 2010, and it shows when compression has occurred for at least 1 month, so 21 trading days is 1 month. And the last time it happened was August of 2024 when the VIX went over 38. The dots on the VIX chart show the compression when it's 21 days. And if you look at the last 14 times this has happened for at least 1 month, the VIX was higher 92% of the time a month later. So if I take all that jibber jabber and translate it into something simple, these conditions, these little dots here, represent times when the VIX has been compressed for more than a month, and what's happened in the future is typically we saw an uptick in volatility. Does that mean the market's going to crash? No. Does it mean that things might get more volatile in the next few weeks? Yes, it could mean that. But when I go back to the chart of the S&P 500, that doesn't mean that this thing's going to crash. It just means that we might see an uptick in volatility over the course of the next month or so, which, by the way, October tends to be a more volatile month. So because October can be volatile, then it's kind of makes sense that we would see an uptick. In other words, Andrew Thrasher's chart makes sense, based on the timing. When we look at bonds, believe it or not, bonds are finally starting to show some life. These are 20-year treasuries, so long-term treasuries. This is not something I'd probably want to be invested in right now, but it's starting to show signs of life here. It's trading above a rising 50-day moving average. It's also trading above its 200-day moving average, but the 200 sloping down. There are other areas of the bond market that make more sense to invest in, things like convertible bonds, things like international bonds, things that are shorter on the yield curve, which is where we have our money invested. But this is just a good look at, call it the long-term treasury market, just to get an idea of what things look like since the COVID crash way back up here in the upper left. So when we look at the dollar, one of the reasons why we've seen an uptick in performance from international stocks is because the U.S. dollar has been struggling this past several months, really pretty much all year. Now, we've got a breakdown here earlier this year, to call it in spring, below this level of potential support, which has now become potential resistance above our head. So we can think of it like a ceiling above our head, all these lows. And we'll have to see what happens, but right now it's just looking like it's trying to base out. But, as long as the dollar struggles, we're going to see things like, outperformance of things like gold, potentially, international stocks, because of exchange rate alone. So, but if this starts to recover, if we start to see the dollar increase, then you're going to see potentially gold start to struggle a little bit more, although gold has other outside factors that it reacts to as well, things like inflation, for instance. But then international stocks, if the dollar does well, then that's not so good for international stocks, which is something we're watching pretty closely. The next thing is the CNN Fear and Greed Index. When I look at this thing, what I like to pay attention to is when we're at extremes. So when the market's really, really fearful, that's usually a time when you start looking for the market to turn around and start heading higher. And when people are extremely greedy, then that's a time when you want to start really looking for things that might roll over. Things might take a turn for the worse. So right now we're right smack dab in the middle, which doesn't really tell us a whole much. It just means that, kind of correlates with the fact that the market's trending up and there's not a whole lot of excitement. People aren't greedy, but they're not fearful either. They were back during the tariff crash in spring. They were extremely fearful. And that's one of the things we showed you back in the first quarter, second quarter, when we did the scouting report video. Speaking of seasonality, this is the seasonal post-election year pattern from Stock Traders Almanac, and you can kind of see all post-election years here in black. So the market has a tendency, like I mentioned earlier, to go down between August 1st and the end of September, and then rebound between October and the end of the year. So we didn't have a down August and September. Instead, we had an up August and September, which that doesn't mean, I know some people who are maybe thinking, well, it must go down then. No, it's quite the opposite. In my opinion, the way it works is when the market bucks the trend and it should have gone down, but it went up, that usually means better things for the seasonally good months. So it would not surprise me a bit if we saw a really, really good finish to the year between October and the end of the year, but especially November and December. If I look at another chart that's very similar, this is just the S&P during post-election years. And you can see here, this is the chart of what the market's done so far this year and where we're at right now. And again, when you look at the S&P 500 post-election year since 1949, you have this period of time where usually it's a little bit flat to down. But here we are again, October through the end of the year. Seasonally, on average, is typically good for the market. When we look at different asset classes, so international stocks, U.S. stocks, small cap stocks, bonds, cash, commodities, and we rank them all against each other to see who's best. Right now, international and U.S. are pretty much tied. So call it international stocks, U.S. stocks are both rising together. And again, international stocks doing pretty well, a lot of that having to do with the decline in the dollar recently. Then you got down here in third place pretty solidly is small caps. We've been waiting for a long time. We're calling 4 to 5 years now for small caps to break out and hold and then head higher, because I think that's going to be an opportunity for a lot of outperformance, or at least some alpha. Alpha is just outperformance above and beyond what you would get from the S&P or the Dow. So that's something we're watching very closely. And then in fourth place is just cash, money market. then commodities, and then in the basement is bonds. So long-term bonds are in the basement again, kind of become an old story at this point. Then we have just again an alert here. This is just historical evidence. I'm not trying to pretend like everything's roses here. I mentioned earlier that the month of October tends to be volatile. October, the last 2 years have been positive for the market. So since 1970, you can see here we had a negative month in 2003, a negative October in 2004. The last time that October was negative 3 years in a row was back in the 1970s. So the chances of it happening again are probably pretty small, but it could happen, of course. So we could see a negative October before things get better, or in other words, see things get, pull back or get worse before they get better. But we'll have to see. Again, there's a lot of great evidence that I'm seeing out there, and a lot more positive evidence than negative evidence. And speaking of evidence, this is what we call in our office the pre-flight checklist. This is an idea that I put together years ago with the help of a couple friends of mine in the business, David Cox and Dave Keller. And what we're looking at here is short-term trends in the upper left. Blue is good, red is bad. Intermediate-term trends, long-term trends. Again, blue is good, red is bad. And then a bunch of other indicators for market climate here in the upper right. And then the middle here on the right is basically it's different indicators that tell us, is it okay to add new money to the market right now? If we've got cash sitting around, is it safe to add new money? And you can see here, generally across the screen, we're looking at mostly blue. And I know the elder candle here, it's green. So it would be green, not blue or red. But anyway, so this is all looking really good. There's very, very little bad evidence. The VIX is a little bit elevated, but that's it. So things, again, they could get elevated from the standpoint of volatility here in the next month. The inverse traffic light that I do every month, we do this in our monthly market brief and send it out to anybody who's on our list. So if you'd like to be added to our newsletter, please let us know, and you'll get this every month. But right now we're solidly in the green here. It would take a drop back to the 2025 spring highs, call it winter highs, before we would even see the caution area again. The market's going to have to do some basing out here before these colors will change. But yeah, even if we fell down to that level, I wouldn't be too fearful just yet. And again, expect to see some volatility in October, and don't be surprised, don't be worried if it happens. You should expect that. So in closing here, when we sift through all the noise in the markets, yes, the government is shut down, but it's temporary. And as we've learned from the data that I've shown you today, the market doesn't tend to care all that much about it. At least it doesn't care very often. August and September, again, are typically the worst 2 months of the year for the market in post-election years. But this year, it bucked the trend. And I think as a result of that, I think it probably means good things for the market during the seasonally positive months, which starts just after Halloween on November 1st. Absolute trends, when you look at the S&P, the NASDAQ, the Dow, absolute trends are up, and relatives, things like discretionaries versus staples, things like tech versus utilities, are very, very much risk on right now. They're pointing to saying it's okay to take risk in this market right now. And then with some exceptions, the U.S. is still the place to be, even though there's lots of great places to be internationally. But even bonds, finally bonds are starting to show some life. And then the best months of the year, as I mentioned a second ago, the best months of the year, seasonally speaking, start on November 1st and they stay that way until May 1st. So that's the quarterly scouting report for the fourth quarter of 2025. If you'd like to get on our list again to get more updates like these in between the quarters, please reach out to us and get on our newsletter list, or just go to our website and sign up. Otherwise, hope you have a wonderful rest of your fall into the holidays, and we'll see you next time.